Hello, everyone. Welcome back to our channel and welcome back to the Capital Insight series within the Fundamentals to Noise series. Today, we're going to focus on the paper wealth luxury trade, why the resilient US luxury demand is a levered claim on the AI rally, and why allocators are quietly stacking correlated bets. The market is reading strong US luxury sales as evidence that demand has diversified away from China. In our opinion, it has not. The strength is concentrated in the top decile of US earners whose marginal spending is funded by equity gains drawn disproportionately from the AI and mega-cap technology rally. Luxury equity exposure is therefore not orthogonal to the AI trade. It is the second-order claim on that same factor. The allocators holding concentrated mega-cap AI risk who add luxury for consumer diversification are stacking correlated bets that will draw down together in an AI-led equity correction. So let's talk about the setup out here, a sector that is leaning on one consumer. Now, after 2 years of contraction, the luxury complex has been stabilizing into early 2026 until the West Asia conflict that began at the end of February disrupted travel and dented spending well beyond the Middle East, with China still fighting deflation and the residue of its property crisis, and European and Gulf demand softened by a tourism channel shock. The sector has been left leaning harder than usual on the American high-end consumer. Now, that consumer has so far delivered. Richemont posted 18% America sales growth in January through March quarter, its ninth consecutive double-digit quarter in the region. North America took the top spot globally for new luxury store openings for the first time on record in 2025. Roughly 27% of the openings ahead of Europe at 26% and China at 19%. Now, this happens even as the global openings fell to their lowest level since 2020. The American houses Ralph Lauren and Tapestry have outpaced rivals on the back of the same demand pool. The convenient reading out here is that US is structurally replacing China as the sector's growth engine. However, in our opinion, that reading misattributes the source of the strength and therefore misprices the risk. Let's talk about the reframe out here. Luxury as a high beta AI proxy. Strip away the narrative back to who is actually spending. US luxury growth is not broad-based wage-driven consumption. It is top decile consumption, and top decile's marginal propensity to buy a watch or a handbag tracks the value to its portfolio far more closely than its paycheck. The 2024 to 2026 wealth gains concentrated at the top have been manufactured overwhelmingly by the AI and the mega-cap technology complex. Now, this is the same factor that dominates the equity allocations of almost every institution that we cover. Now, this collapses a diversification assumption that sits, often unexamined, inside multi-asset books. So there are three parts to this. First and foremost, the wealth effect is the demand out here. When luxury management describes the US consumer as loyal and resilient, they are describing a cohort whose confidence is a function of the asset price. Resilience here is a derivative of the S&P concentration rate and not an independent variable. Secondly, the luxury beta is now the AI beta, one step removed. A long position in LVMH, Richemont, Moncler for consumer exposure is, in current conditions, a laggard or a levered expression of the AI equity rally transmitted through the spending of its beneficiaries. And thirdly, the hedge, which is not a hedge. Books that pair concentrated mega-cap AI exposure with luxury equity to soften single-factor risk are doubling the factor and not diluting it. The two legs are positively correlated precisely in the scenario that the hedge is meant to protect against: a sharp AI-led drawdown. We have covered this previously in our other videos also, specifically the AI Stack Capital Map video, wherein we shared with you the luxury demand is best understood as a wealth effect spillover from the value created across the stack, downstream of the training compute and the inference layers captured not by the operators but by the equity holders who fund it and hold them. It is the most consumer-facing and least acknowledged beta on the AI build-out. Next, let's talk about the structural caveat out here, a cyclical bridge and not a new foundation. Even taken at face value, the US cannot carry the sector. American nationals account for roughly 20 to 22% of the global luxury spend. A fifth of the market growing strongly is a welcome cyclical bridge. It is not a structural replacement of 2 decades in which China was the dominant source of incremental demand. Bain's framing of a two-speed world, the US and parts of China expanding while Europe and the Middle East absorb the tourism shock, describes the sector running on one cylinder and not a rebalanced one. The store opening data also cuts the same way. North America leading global openings reflects genuine underpenetration relative to its wealth base. But it also locks in fixed cost, long duration capex cycle calibrated to demand that is, in our read, asset price contingent. Flagship leases on Fifth Avenue and across lower tax second tier cities are sunk against wealth effect that can reverse faster than a stored footprint can be unwound. Peak US confidence and peak US capex are arriving together, and that is usually a vulnerability signal and not a durability one. The honest conclusion is one that the sell side caveat already gestures at. A real recovery still needs China to inflect. Until that does, US strength is papering on an unresolved demand hole, and the paper is marked through the AI rally. Let's also talk about the transmission layer out here, the Middle East tourism channel. The Europe and Gulf weakness is not principally a local consumer story, it's a travel and tourism story. The Iran war, that is the West Asia conflict, has throttled the cross-border tourist flows that underwrite a large share of luxury sales booked in Europe and Middle East. For Punjab Capital Research purpose, this is the same choke point weaponization shock that we have already tracked through oil, marine insurance, and foreign exchange, surfing now in discretionary consumption channel. So in effect, what can be said is that luxury has become another transmission line for the geopolitical disruption, and the apparent US outperformance is partly a denominator effect flattered by the simultaneous impression of the tourist-dependent regions. Now, that's all that we wanted to share with you with respect to the luxury paper trade. Hope you've enjoyed this particular episode of the series. Stay tuned and for our next one.